Good morning. We are Group 7 and we'll be talking about something that can make or break a business working capital. Now, many businesses don't fail because they lack profitability. In fact, on paper, they may even look successful. They fail because they run out of cash. And when cash dries up, even the most promising business can come crashing down. That's why effective working capital management is not just about survival. It reduces it reduces funding needs, enhances liquidity, and accelerates growth. It all comes down to three key levers for optimizing the cash cycle, which are supplier terms, inventory period, and customer terms. By negotiating with suppliers and extending the period before payment is due, businesses can hold on to cash longer. By reducing the time products sit in stock, businesses free up cash that would otherwise be tied up in warehouses. And by collecting payments from customers faster, companies can improve cash inflows and avoid cash shortages. Now, let's go to working capital model, which essentially means all the current assets excluding the current liabilities. But in practice, what really matters is the timing of cash flows. In a positive working capital position, businesses pay suppliers and incur costs before they get paid by the customers. This means cash is tied up in operations. If not managed carefully, it creates a gap that often forces businesses to borrow money or dig deep into their reserves, making it a risky situation. On the other hand, negative working capital is actually the ideal state. Here, companies receive cash from customers before they pay suppliers. Customers are essentially financing the business operations. That gives the company a big liquidity advantage and allows for self funded growth. So, the real goal for businesses is to shorten or even reverse the cash conversion cycle, moving closer to a negative working capital for maximum flexibility. Now, let's discuss a case to understand its real life applications. The first is of Joe Jones. We all know that he owns one of the world's largest leading financial media companies, Wall Street Journals. But over the years, they faced huge pressure. Print media was in decline, advertising revenues were falling, and their traditional business model was no longer sustainable. Their traditional business model, the process was simple but very problematic. The first they first spent heavily on creating content, printing news, and distributing them. Only after selling ads in paper did they get paid. That meant cash was always going out before it came in. It created a positive working capital position and a constant cash crunch. As the market shifted, they began a transition phase, focusing more on digital platforms and premium content. This helped to reduce costs but didn't fully solve the underlying cash flow issue. The real breakthrough came when they shifted to a subscription model. Now, instead of waiting for advertising revenues or individual sales, customers paid annual fees upfront for digital access. That meant cash came in first before the company had to spend on content creation and operation. This flipped their financial model into a negative working capital. This impact was very powerful. They now had steady, predictable cash flows and reduced reliance on external funding. Moreover, they had financial flexibility to invest in digital transformation and long term growth. Now, my group partner, Devi, will discuss further case studies.
Thanks, Nikita, for a wonderful, insightful lesson on the working capitals. Now, let's look at Costco, the wholesale giant. Retailers usually face a tough cash cycle. They buy inventory, pay suppliers first, and then wait for the customers to purchase. That's positive working capital, and it ties up a lot of cash. Costco flipped this cycle entirely. First, customer pay membership fees upfront, giving Costco cash before even the sales begin. Second, products move very quickly thanks to the limited high volume selection of products. Means that turnover is very fast. And third, suppliers are often paid after the products are sold. This means Costco enjoys negative working capital. In simple terms, customers are financing its business. That's why Costco can expand rapidly, price competitively, and still remain financially strong without relying heavily on debt. Now, let's move on to another beautiful example of Dell computers. In 1990s, most PCs manufacturers like HP or IBM built their computers first, then stored them in their warehouses, waiting for them to be bought by the customers. Now, this locked up a large amount of cash and created huge risk if there is a sudden technological disruption or change in the customer's perception. Dell, learning from these companies, took a very smarter route. Now, they introduced something called as build to order model. In this model, customer paid upfront while placing their customized VC order. Only then they order the components and assemble the machine. Suppliers, meanwhile, were paid 30 to 60 days later. So Dell always had the money coming in before it went out. So customers, not banks, funded Dell's growth. This negative working capital gave Dell a huge edge. Rapid scaling, less debt, and no risk of unsold inventory. Now, let's move on to the final part of this video. That is conclusion. So, all three cases tell us the same story. Dow Jones used subscription to fund its shift. Costco used memberships and turnover to expand. Dell turned customers into investors. The lesson is loud and clear. The best businesses model don't just manage profit, they manage cash flow. Thank you and see you in the next one.